Welcome to Evergrande Financial Group's educational series. My name is Mark Painter, and this is video 1 of Stock Market 101. Stock Market 101's goal is to help new investors develop an understanding of the investment landscape and arm them with tools to assist in the decision-making process. So in general, there's two types of people that participate in the stock market. And you want to first identify who you want to be. A trader is typically someone who enters a position for a short period of time. You're going to focus on charts and you'll have predefined risk and return parameters. Additionally, an investor is someone that is looking to hold a position for a long period of time. Usually you hold it for at least a year, and you should spend the majority of your time looking at the fundamentals. For the purpose of this video series, we're going to forget about the trader, and we're going to focus on the fundamentals of investing. So two of the things that people have concerns with a lot are, one, why does the stock market exist? And two, why does a company's stock price move up and down? Public companies are just like any company, any private company that you see, and they have a purpose to provide profits to its stakeholders. On any given day, the price reflects what someone is willing to pay for the future profits of that business. And public markets are a form of current and future financing for that company. So let's take an example, a financing example. If you want to buy a house, you can't afford to pay for that house all up front. So you want to go and you and your family, you want to buy a new house, and you can't afford to pay $250,000 in cash to buy that house. So what do? You go to the bank, you get a mortgage, and you pay interest to that bank, and you move into the house, but you pay them off over time. A public company is set up similarly. So over here you have your company, and this company wants to generate returns over the long term. So they want to invest in, let's just say they want to open 10 new stores. Well, most companies don't have the ability to just spend the money to open those stores. So they need to finance the opening of those 10 new stores. Instead of going to a bank, what they do is a public company goes into the public market, and they can either do one of two things. They issue debt or bonds to investors, similar to when you take out a mortgage, where the investors require a certain bond interest, 3%, 5%, 6%, in order to lend their money to this corporation. The other form, which is what is used in stock prices, is those investors share with the business in what's left over, which is the equity of the company. So one of the things to look at is the capital stack. Because we're going to focus a lot on common equity, you need to understand that there are different investors in a company. So the capital stack over here is, this is a very simple version of it, but you can see at the bottom you have senior debt, and then it goes up to mezzanine debt, preferred equity, and then common equity. And so the best way to look at this is if this company was to cease to exist today and they sold all their assets and everything that they had, well, first they would have to pay off all their debt holders, and then they would pay off their mezzanine debt and preferred equity, and whatever's left over would go to the common stockholders. This is important and will become more important as we get into further videos, but this is a good place to start to understand where common stockholders sit in the capital stack. The next part is how stock returns are broken down, and it really breaks down into three pieces. One is earnings, two is a return of capital, so that's either through dividends or buybacks, and then three is valuation, what someone is willing to pay today. Over here on the right, you'll see a chart which goes back through 2016 and breaks down total return, which is the blue diamond of each year, and it breaks it down into the orange part, which is the valuation, the PE multiple, what people are willing to pay each year. The blue square, which is the earnings of that company for each year, and the most consistent, which is the gray, which is the dividend that is paid. That's the return that they give back to their shareholders every single year. So those are really the forms of return that you get from a stock. So going forward, we're going to break out some other videos that focus on how to research these different pieces. Because capital return and earnings are the most predictable over the longer term, we want to focus on how to evaluate and predict this. And that requires looking at the income statement, the balance sheet, the cash flow statement, having an understanding of the industry and company KPIs, which are key performance indicators, and lastly, whether a company should be considered a growth or a value company. Thank you very much for listening to this first video in the series. If you'd like to learn more or listen to some of the other videos, please click on the bottom right and subscribe to our YouTube channel.